Hello, welcome back to our channel. In today's video, we are going to cover a full 5 minutes, 15 minutes and a 30-minute scalping and swing trading strategy. Not only you will get a full trading strategy, but we will also share with you a real chart examples using a single pattern that is easy to understand. Whether you are a beginner trader or an advanced trader, you will find this trading strategy to be the only one you'll ever need using a zigzag pattern. We will start by doing some recaps from our previous videos so that you can understand everything that we are going to cover in this video. For this strategy, you will only use a 50 minutes, 5 minutes and a 30 minutes. So before we begin, this is the things that you should know by now. You should understand the market structure. You should also understand the fair value gap and a imbalance, a confirmation candle that will confirm when the price is ready to move or how you're going to enter the market. Time frames is this ones here, how to place a trade, risk management, impulse and corrections, and finally how to draw supply and demand zones. We will do a recap of these things here, of the topics that we are going to cover in this video. All the timestamps will be in the description below so that if you already know these things, you can skip and move on to a real chart example or move to where you don't understand clearly. So let's start with the first recap. This is the basic market structure pattern. We can see that right now on this area here, we are moving to the upside. We will have higher highs and higher lows, higher highs, higher lows, higher highs and higher lows. In between here is what we call a correction, and then after this correction you will see that the market will move higher above this high here to make another higher high, and then finally we have the last higher low. When the market breaks this last higher low, that means the market is going to change direction. From here we can see clearly that after we have broken down this last higher low, the market started to push to the downside. And then to understand how the market will change from being bearish to bullish is the same scenario. You have to wait for the market to break the last lower high, which is this one. We can see that even in here, the market didn't break. This is where you see a change of character. And then all in all, this is just a huge move like this. We can see that we have a higher high in red and then a higher low in red and a new higher high in red. This is just a whole move. And then we have, this is the major structure, and then we have a minor structure inside this major structure here. This whole pattern here will look something like this here. Higher low, higher high, higher low over here, and then a higher high. So inside this structure here, this part here is this one over here. Okay? And then inside this structure where the market is being bearish is this structure over here. This is just a recap to understand how the market structure moves. So let's move on to another recap. This is another recap of fair value gap and imbalances. We can clearly see that we have a bearish candlestick here and then followed by a series of bullish candlesticks here. But to understand a fair value gap, you have to understand that a fair value gap is just a shift in price action that leaves spaces between candlesticks wicks. So mostly you will see fair value gaps when the market is moving aggressively to the upside or to the downside. The market will leave some spaces in between the wicks. Like for instance here you can see that this wick here doesn't touch, so that means the market didn't close this fair value gap here, this gap in between the wicks. So that means the price jumped aggressively to the upside, leaving a space where the market might fill in price in the future. So we are going to use this fair value gap in our analysis like this. We are going to predict that the market might eventually come and close this gap here before it can shoot higher again. That's how you should understand this. And we can also use fair value gap to predict the market and do our analysis better. This one is pretty easy to understand. You just have to go into the market. You will see this fair value gap happening in real time. So let's move on to another recap. On this one, we are going to recap on how to draw supply and demand zones. So on this example, we are only drawing supply zones. So on the first pattern here, we can see that we have a bullish candle and another bullish candle here. So when drawing your supply and demand zones, you will start from the low of this candlestick to the higher high of either the bullish candlestick or the bearish candlestick. So for example, if this wick was higher like this, we are going to draw the zone like this. So if this high was like this, we are going to choose either the candlestick that is having a higher high like this, because right now we have two candlesticks here. That means we are going to draw the zone from either the low or to the open. But if you want to reduce the risk, you can still do something like this. But to be precise, we are going to start from the low to the high. So on the next one is a non-engulfing pattern. We are going to start from the previous candlestick, which is the bullish candlestick, to the high of either the bullish or a bearish candlestick. This is a non-engulfing version of supply zone. And then lastly, this is a bearish engulfing supply zone. We are going to draw it like this. We can see that this bullish candlestick does not have a higher high over the bearish engulfing candle. So we are going to use this high here. That's how you draw your demand and supply zones. So why do we need to draw the supply and demand zones? We use this trick to anticipate that the market might potentially come to this area in the future and then reverses to the downside. Same on this side, we will predict that the market will come to this area and then reverse. And also on this side, the same as this one. It's pretty much simple to understand. You will see when we move on to a real chart examples. So let's move on to another recap, because right now you remember on how to draw your supply and demand zones. You need a confirmation candle. A confirmation candle is a candlestick that will be printed on the supply zone or a demand zone that will confirm that price might potentially move to our anticipated direction. So for instance, on this example, we can see that we have a supply zone over here. So the market is moving to the upside, and then on this area here, the market prints a bearish candlestick. So that means this zone here is holding price to the downside. So another thing that I want to point out is that on this supply zone, if you see that this candlestick traded above this zone and then closed with a bearish candlestick, that means you should avoid that entry, because this will invalidate the whole pattern. And then another thing, a confirmation candlestick on a supply zone will be a bearish candlestick, and then on a demand zone, a confirmation candle will be a bullish candlestick. So let's move on to another recap. On this area, we are going to discuss about impulses and corrections. This will also benefit you to understand the market even better. This area here is the impulses. Those strong moves in the market is the impulses. Impulses set the direction of a trend, and after every impulse, there will also be a correction. For example, we can see that we have a bullish impulse here, and then the market started to correct here. So after every correction, the market will make another impulse. So another thing that I want to point out is that when a correction is bearish, you will see that the next move will be a bullish impulse like this. For example, on this area, you can see that we have a bearish correction and then followed by a bullish impulse. And after a bullish impulse, you'll see that we have a bearish correction again, followed by a bullish impulse. This is vice versa in the bearish trend. So after every impulse, impulses set the direction of a trend. So if you see an aggressive move to the upside or to the downside, you just know that the market will correct. And when you see that the market is correcting, just know that the next move will be following the previous impulse. Like for example, on this side, we can see that the market made a impulse here, a very strong impulse. Mostly you will see an impulse. An impulse is created by a huge candlesticks, like a fast movement in the market, like during news event or so forth. That's when the impulses are being set. And then after that, the market will start to correct opposite direction of the impulse. For instance, we can see that we have a bearish impulse here, followed by a bullish correction. And then after this correction has completed, this is the area where you will be looking to go short. You will be looking to sell here to catch this next impulse to the downside. And this move will be very aggressive to the downside. So you have to be fast to enter the market. And another thing is that you can see that these boxes from the impulses are very small, but the corrections are very huge here. Impulses are strong. is because an impulse can happen in one day, but then a correction can complete in 2 weeks. Okay, so you have to be patient when you are in this area, and also be careful when you are trading inside a correction here. Sometimes you'll realize that when you are in a correction, you'll always say that the market, or maybe this week the market is very slow. It's not very slow, it's because we are trading inside a correction. Okay, so let's move on to this first lesson of this video. This is the only pattern that we need to focus on inside this video. It's pretty much simple. You can pause the video and draw this pattern down so that you follow along with me throughout this lesson. So from this area here, on this first area, you have to identify an impulse. Okay, after this impulse, you have to find this low here, and then wait for the market to break this low, and then lastly wait for the market to go up and then break this low. That's when you will be looking to go long around this area. This is a zigzag pattern. You can find it online through Elliott wave lessons. This move has to be fast and this one has to be slow. Okay, and then the same thing in the bearish view. This move right here has to be very impulsive, has to be very strong to the downside. And then you will wait for the market to start to correct, break this high. Then you can just put a line around this area, wait for the market to go down, break this high, this previous high, and then you put a line on top, and then wait for the market to retrace down. When the market tries to break this high here, that's when you will be looking to go short around this area to the downside to catch this move. You can see that I'm teaching you to catch only the fast moves in the market. Okay, so it's pretty much simple to understand. You can still pause the video right here to understand it clearly. But if you draw these things down, you will understand them very clearly. So let's move on to another section of this video. So right now we have covered the zigzag pattern. So right now we will use some manipulations used in smart money concepts. So you will see that we have a move to the downside. Maybe let's say this is a preceding or a previous bearish trend. In this area, you have to wait for the market to come down, make a low here, push higher, drop lower, breaking this previous low here. Then when the market shoots higher like this aggressively, you will have a major higher high. That's when you will draw your demand zone around this area here. And then you can also identify a fair value gap around this area. Then when the market starts to shoot lower, you will circle this low, you will mark up this low here when the market starts to retrace to the upside like this. Okay, then you will have a minor lower high here. So then you will identify that the market will move lower, breaking this low here to make another low. The market will reverse to the upside, and then in here you have to identify everything. You should be sorted. Your analysis will be complete. You can see clearly that this analysis looks like a Quasimodo pattern, something like that. And then when the market starts to shoot lower, you will wait for the market to make a bullish candle here. This will be your confirmation candle. So to enter the market in this area, you wait for this candle to close, you enter the market, put your stop loss below, and wait for the market to shoot to the upside, and then targeting this previous high here. So all in all, you will do something like this. You will enter the market here, put your stop loss below with added spread size, target this area here. And sometimes you can even target another previous highs from this side of the market. It's pretty much simple to understand, guys. So let me show you a complete structures of this trading strategy before we can move on. You can see right now here we have more than one pattern, but eventually they look almost the same. So from here on this lesson 3, we can see clearly that this pattern here will target this low here. We will target this low, and to make it simple, just number your highs here. We can see clearly that I have numbered my highs. It's 1 and 2, and then I will wait for a confirmation candle around this area and then enter the market without fear. And then this one pattern here, you'll see that it will manipulate this low like on this one, and then it will also manipulate this previous high here, and then you will see that you have one high here. This one is not a high here because price traded below we have a high, a high. So when price move to the upside here, once you have your supply zone, just wait for the market to make a confirmation candle around this area before you can take a sell position. This one here is the same thing as this one, but vice versa with a pattern that is targeted to manipulate the previous low. You can see that we have a high, we have a high, and then we have a low. This move here, you will see that this move will be very strong. But then when price move to the downside, you will see clearly that you have a low here, and then price shoot to the downside. A low here, price shoot to the downside. Manipulating this low here. Once you have the demand zone, just wait for the market to print out a confirmation candle around this area to trade to the upside. And then for the complex version of this patterns, you will see on the chart that price will move something like this, breaking this two lows here. But when price move to the downside, this area will be a few candlesticks, even on this one. A few candlesticks, but those candlesticks will be a bullish candlesticks, because a bullish candlestick in a bearish trend will make something like this. Okay, this will be your lows here. So it's the same thing as this version here, but this one is very complex. You'll understand it when you go and backtest. Most of the time they won't be clear, but you have to understand how a candlestick is formed. And then lastly, on this one is very complex. Sometimes you will lose a trade when entering around here, because the market will make another leg here, which is number 3. But it's very rare for this pattern to happen. So if you identify this happening inside the market, just to wait for the market to print out a confirmation candle here and then enter the market. I hope everything from the beginning of the video was very clear before we can move on to a real chart examples. So before we move on, I want to touch on some other things. On this lesson 4, we are going to do a real chart examples. And another thing is that I have noticed that some of you guys binge watch these videos without backtesting. Also try to backtest, because if you don't backtest, guys, there is nothing that is going to benefit you from this video. You're just watching it as if like you're watching a Netflix. But after watching this video, please go inside TradingView or any other platform that you are using to trade and backtest these trading strategies. And after backtest, you will realize that those patterns are easy to identify. You will never struggle again. And then another thing is that please also, the link to our free Discord channel is in the description below. Please support by joining the Discord channel. And another thing that I want to point out is that we have the cheapest free ebook in the description below. You can go and check it out. It's only $5. And if you want to join our private Discord, the link will be in the description below, or you can also contact me on Discord and only text the admin. And just know that I am not going to text you to sell you anything, because I have noticed that there are a lot of people that are using my username to contact you directly to try and sell you something. So let's start with the first example here. We can see right now that we are still on the 5 minutes time frame on gold here. You can clearly see the pattern here tend to form. Let's try and do it. We have a low that is manipulated from here. You can see that we have something like this. Okay, and then we have a high again, and then a low around this area. Then the market moved higher like this, but because we are trying to reduce the risk as much as possible, right now we will try to find those 3 lows here, something like this. So we can see that we have a low over here, we have a high, we have a low. We can see that these higher highs here, they are not breaking the previous highs here. You can see we are waiting for price to break this low to reach this area before we can take a trade to the upside to target maybe at least this high or more. So let's make this a clear setup. We will start by drawing the zone around this area here. Right now we have a zone like this, and then we can see that price traded below the zone. That means price manipulated this low first, and then right now we will be waiting for the market to make something like this. Then on this area, that's where we will wait for the market to make a bullish candlestick, because right now you can see clearly that this is our demand zone over here. Have a demand zone, So right now we are waiting for the market to make a confirmation candlestick here, and then we will be looking for the market to shoot to the upside. That's pretty much simple. So right now, let's see how the market, we are waiting. We can see clearly that right now the market made, after touching this zone here, the market made this bullish candlestick here. So this is our confirmation candle. So we are going to enter using it. Let's put a long position. We can enter here or wait for the market to retrace back here and then shoot higher. But because we don't want to miss out, we will enter the market right here and then target this high here, or even, because this is a 1 to 2, we can even target a lot of pips to the upside because this is gold. Let's see how the market did. We can see clearly that after this bullish candlestick here, the market even retraced back. We can still use this retracement to reduce our risk like this, and then the market shoot higher, giving you a profit. You can see that the market even pushed even higher. So that's how simple it is. Let's try to find another example. If you remember, I have mentioned that there will be some complex versions of this pattern. So I'm going to touch on that before I make more examples. So we can see right now that we have something like this over here. We have a move to the downside, a high, a low, a high. Okay, we have a low, a high, a low, a high. Okay, and then we have a low. This bullish candlestick here is a high, it moves to the upside, and then we have a low, we have a high, and we can see clearly that right now we have 1 and then a 2 here. So after price has broken this low here, we can see that right now we have a demand zone on this side. This is still gold on the 5 minutes. So right now, because the market is still in the demand zone, we will wait for a bullish candlestick. Let's see. The market tried. Okay, we have a bullish candlestick over here. We will enter the market like this. Put a stop loss below, target this high here. You can even try to swing trade this pair. Let's see how the market unfolded. It tried to stop us out. Okay, and then price started to shoot to the upside. You can see clearly that this move was very aggressive to the upside. Imagine if you entered here with a small stop loss, and then that is 1:35 on a simple trade setup. Okay, this is pretty much easy to understand. Okay, let's find another example. This is another example here. You can see that we have a high, a low, a high, and then a low. Okay, you can see that right now price is trying to move to the downside, and then we have a 1, 2, and then a 3. We will draw our zone here using this 1, 2, 3 candlestick. At this trade setup like this one here, we can see clearly that price traded above the zone. That means you are not going to take this trade because there is no confirmation candle at the first place, and then price traded above the zone. So even if price closes with a bearish candlestick, yes, it can still shoot to the downside. But this is not how you are supposed to take this trade here. Just avoid this kind of setups and move on. You can see price closed with a bearish candlestick here and started to shoot lower. But if you are placing your sell limit orders around here, that means you will be out of this trade, and some of those guys who are watching this video will benefit from this trade by not entering the market. So you will be in a loss, but those who are watching this video right now will still be on break even. Another example is this one here. You can also compare. This move on this side is very fast. This move on this side is very fast, and this one here is very slow. So that means we have an impulse, a correction. So the next move is to the upside. So let's analyze. For this trading strategy to be simple, you have to mark the lows. Understand these lows. We have 1. You can see that we have 1. Price traded below it and then shoot higher. That's when you have to find the zone around this side. Let's find this zone. We have a zone, and also price touched the zone here, close with a bullish candlestick. That means you just enter the market like this, put a stop loss below, and then target whatever you want to target. So let's see how the market unfolded from this side. You can see the market moved to the upside. Okay, the market moved to the upside like this. So that's how you're going to benefit from this trading strategy. So let's do another example again. Okay, let's do another example over here. we can see that we have a bearish trend here, and then we have a bullish trend like this. To make it easy, let me show you something. We are going to draw a box from this high to here, and then we are going to draw another box from this side. Which one is bigger? This one here is the bigger one, and then this one is smaller. So that means the smaller one is the impulse, the bigger one is the correction. So that means before you can do anything, you can anticipate that the market will make an impulse around this area here. So that means the market is still bearish. Okay, so from here, guys, let me show you something. So from here, just check how the market is moving. You can see clearly these ones here, they are not the highs because the market didn't break anything. You can see clearly that we have a high here. Let's write it 1. This is our first high. Okay, and then we have another high over here. Let's write it 2. And then we have another high here, which is 3. And then if you were lucky enough, if price action was at this area, you can see clearly right now you will draw the zone from here. So that means you will be entering the market using this bearish candlestick here. You'll enter the market using this bearish candlestick. So for now, that means you are still in a trade here and waiting for the market to shoot to the downside. So let's see how the market unfolded. Okay, price even traded above this. It just tapped this previous high here. But if you are still in a trade like this, that means you are not even stopped out because your stop loss will be above this area here. So because you know already that the third leg can also be broken too, that means you can still enter one more trade around this area and then trade to the downside. Let's see how price moved. Okay, you can see you'll be targeting maybe this low here. You are close to your take profit levels around this area. Okay, you can see even price was shooting lower. Your stop loss is very small on this trade, so you will be holding for more potential profits in the market. And I see another one in this area here, but it's very complicated. Let's find out. Let me remove everything. You can see we have a high. This is 1, this is 2, and then you enter here using this supply zone here. Enter with this bearish candlestick and then wait for the market to shoot lower. That's how you are going to scalp the market. So let me find another example, because right now I was using the 15 minutes time frame on gold. Let's try another pair. Let's find another pair. Let's start by drawing the boxes from this low to this high and then to here. You can see right now that we have some differences in the market. What's going to happen here? Let's find out. We are going to make or draw the lows. We have a low, we have a low, we have a low, and then the market started to make some lows here. Let me remove everything. From here we can see that we have something like this. Have a low, a low, a low, a low, a low. But the major ones are these bigger ones here. And then that means you will be looking to enter the market. Looking on this side, you can see clearly that we also have a fair value gap in between here. So that means we are going to draw the zone from this bearish candlesticks here, go into the side, and then you will enter with this candlestick here looking to the upside. So let's see if the market moved to the upside. That means this trade has stopped us out. Look, doesn't mean you're going to win all the trades. You have entered with this bullish candlestick here, but before price can shoot to the upside, it stops you out first. You will never win all the trades in the market. So that's what I wanted to show you. So risk management is very important when trading. If you don't use the risk management, that means you won't have a potential to make money in this market. Let me show you another example that is very difficult, but you will understand it clearly. Let's try and put our boxes again, and then you can clearly see where we are in the market. We are still correcting. We have a bullish impulse, and then we have a correction. So that means right now we are waiting for another move to the upside. And we can clearly see that we have one major low here, and then we have a fair value gap on this side. This one is just an ABC correction, so I won't touch on that, but it's the same thing to the upside. You can see you enter here with this candlestick using, let me remove this everything here. You enter using this zone, including this fair value gap around this area. This is a ABC correction because it breaks the previous low, but it doesn't break this high here, doesn't break and then you enter here, you wait for the market to push to the upside. That's how simple it is. So let's try to find another example again. This is another example on a complicated market. You can see this thing doesn't even have direction. What is happening here? This thing doesn't even have direction. You don't know where price is going. But another thing, you can see we have this box over here, and then we have this one. This one should also give you a signal what is happening here. That means the market is still correcting. So let's check on this side. We have a move to the upside like this. We have this area here. If you put your arrows here, from here, you can see we have a move to the upside. But if I put an arrow here, the market is not moving higher. You can see that we are going down. So this area here should also give you a signal on how the market is going to play out already. That's how the market is going to move. We need a smaller version like this side here. We are expecting the market to make another impulse. So from here, let's find the lows. We have a low here. You can see we have a low, a high that is not breaking this high. We have a low and then a high that is not breaking this high. And then we have our zone here. This candlestick close touched the zone. So that means we are expecting the market to shoot to the upside. Okay. And then our stop loss will be below this zone here. Your entry will be here, or you can use a retracement. Okay, from this, that means we are done already from this section of the video. Then let's see how the market unfolded. Okay, you see the market retraced back to the previous candle's low, previous candle's open, which is this bullish candlestick here, and then price shoot higher. That's very simple. That means you enter a trade, you see profit same time. So guys, I think this will be the end of this video because I'm very tired. I can do more examples. Please consider subscribing to the channel, like the video, comment below. If you have any question, please come to our Discord channel so that we can cover some of the things from this video, because this is a full trading strategy completely. If you understand this video, that means you are a trader. If you understand everything that I have covered in this video. Okay, I hope I'll see you on the next one. Please enjoy your day and have a lovely evening or morning if you're watching this in the morning. So guys, I'll see you on the next one. Ciao.